We're analyzing Cisco Systems, stock ticker CSCO, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Cisco. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. There will be a key bonus metric along the way that just might be the tipping point when analyzing Cisco for your stock portfolio. Before we get into these valuable metrics, let's understand Cisco's stock performance. Right now, Cisco trades for $53.34 per share. Year to date, their stock price is up 12.5%. Even though this is up, this is underperforming the market. In the last 5 years, Cisco is compounding at just over 3% annually. In the last 10 years, they're compounding at 8% annually. Going back before the global financial crisis, in the last 2 decades, Cisco's compounding at 6% annually. Right now, Cisco pays an above average 2.86% dividend yield. Their average dividend yield over this time is added to the returns in their stock. Cisco trades just $1 below its 52-week high. Cisco's up more than $12 from their 52-week low. Cisco is a huge business. They have a $219.5 billion market cap. But the burning question is, why should we be paying close attention to Cisco? Cisco Systems is the largest provider of networking equipment in the world, as well as one of the largest software companies. Its largest businesses are selling networking hardware and software, where it has leading market shares, and cybersecurity software like firewalls. Cisco also has collaboration products like its WebEx suite and observability tools. It primarily outsources its manufacturing to third parties and has a large sales and marketing staff, 25,000 strong across 90 countries. Overall, Cisco employs 80,000 employees and sells its products globally. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Cisco's average return on capital in the last 5 years to be above 14%. The average business earns a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Cisco's returns on capital have improved throughout this time. They earned just under 28% returns in their last fiscal year. When these are averaged out, Cisco earns 24.5% returns in a given year. That's more than 3 times better than a typical business. This is a big check on metric number 1 for Cisco. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth to go with their high returns. This metric's all or nothing. All 3 need to be up for this to be a check. We'll include their last 12 months of numbers in our calculations here. In this time, Cisco's grown their revenues by 11%. Their earnings look like they're up big. This was because the company had a $13 billion tax expense in 2018. Even if we remove that from their earnings, Cisco's still grown their earnings throughout this time. Even if we normalize their taxes for their earnings in that year, Cisco's earnings would still have grown throughout this time. And Cisco's grown their free cash flows by 31%. These 3 are up across the board for Cisco. This is our second check of the day, coming in on metric number 2. Metric number 3, we're looking at Cisco from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. Cisco's grown their earnings throughout this time, again, even excluding those tax expenses in 2018. As they've grown their earnings, Cisco's also bought back 15% of their shares outstanding. They've repurchased 1/7 of their business over this time, increasing existing shareholders' ownership without having to spend a dime. It depends on Cisco's valuations as to whether these buybacks created or destroyed value for shareholders. We use 2 different methods later in our analysis to estimate their fair value, so you'll want to stay till the end. With their earnings up and their shares outstanding down, this is a check on metric number 3 for Cisco. We're perfect so far. Can Cisco keep this going? Metric number 4, we're looking for something similar. We want to see free cash flow per share growth in the last 5 years for Cisco. In business, cash is king. It's the lifeblood of any company. Ultimately, a business's abilities to produce free cash flows now and until judgment day, discounted back by some reasonable interest rate, is what that business is worth. We want to see 5-year free cash flow per share growth for Cisco. Similar to their earnings, they've grown their free cash flows and they've also bought back these shares, meaning Cisco's grown their free cash flows per share. This is a check on metric number 4. To recap, currently we have 4 checks and no X's for Cisco. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Cisco apart, which is having these without using a lot of debt. Metric number 5, we want Cisco's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Cisco's had negative net debt throughout this time, meaning they have cash left over after paying off their debts. Cisco ended last year with $8.7 billion in cash. Right now they have have $13.8 billion in cash. At the same time, Cisco generated nearly $70 billion of free cash flow when we add up their last 5 fiscal years of free cash flow. This is a monster check on metric number 5. Cisco seems to be in very healthy financial position. They have a big cash cushion and they generate a lot of free cash flow. Another check here on metric number 5 means we're flawless through our first 5 metrics. Does Cisco have what it takes to go 6 for 6 and be a perfect select 6 stock? We'll find out right after our bonus. As our bonus, we're looking at Cisco's dividend profile. Right now, Cisco pays an above average 2.86% dividend yield. We want Cisco's dividends to be supported by their free cash flows. That's been the case in all 5 of these years. Cisco's also grown their dividends over this time. They've also grown their free cash flows. With growth in both of these, Cisco maintains a small and reasonable dividend payout ratio. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. Cisco supports their dividends over this time, and they do so today. This is a check on our bonus. Now let's get into our valuation methods. The big metric of them all, metric number 6, we want Cisco's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Cisco. Right now, Cisco has about a $206 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Cisco similar to it being a private company. In the last 5 years, we learned Cisco generated $70 billion of free cash flow, meaning they generate around $14 billion of free cash flow in a given year. When that's divided by their $206 billion enterprise value, we get a 6.8% average free cash flow to enterprise value yield. On a current basis, Cisco produced $16.8 billion of free cash flow in their last 12 months. When that's divided by their $206 billion enterprise value, we get an 8.2% current free cash flow to enterprise value yield. Both these yields are above the yield of the 10-year treasury. They're also above the yield of some of those shorter term notes as well, and they're above the risk premium we're seeking. This means coming in all the way on metric number 6, this is a check. Cisco's done it. They go 6 for 6 on our analysis, and they're a perfect select 6 stock. Don't just run out and go buy the business. This is meant as a starting point for more research. Plus, we still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Cisco, which takes us on to using a discounted cash flow model to estimate Cisco's fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Cisco's current free cash flows and using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Cisco. Cisco's been a very predictable business in its past. That's not a guarantee for the future. Yet it better informs our assumptions. Assuming Cisco grows their free cash flows at 6% annually for the next decade, then in the following decade, assuming these free cash flows grow at 5% annually, we'll add in their tangible book value to give an estimate of their net worth. Keep in mind how the accounting is done for their share buybacks may skew this tangible book value, so that's something you can dig deeper in and potentially add back to our analysis. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, from today's valuation multiples, if these are the same 20 years into the future, an estimate of Cisco's fair value per share is around $39. That's down around $14 from their current stock price, but it's within their 52-week lows. Cisco's business predictability informs our assumptions, but it's not a guarantee for the future. Keep in mind this discount rate is an estimate of total returns to shareholders. It includes both Cisco's dividend yield and any gains in their stock price. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Cisco, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for Cisco's business. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, Cisco's balance sheet is strong and it generates impressive free cash flow. Its management is shareholder friendly and sends most of its free cash flow back to shareholders through a high shareholder yield. Number 2, Cisco's shift toward a higher mix of software and subscription-based consumption models is a positive for its business. Number 3, Cisco holds dominant market shares across networking and leads shares in areas like switching software and software-defined wide area networking, or SD SD-WAN, these bode well for its position in the next era of networking. But we'd be remiss if we didn't cover the negatives of Cisco's business as well, looking at the factors supporting a short thesis. Number 1, in high-speed public cloud applications, Cisco lags Arista Networks in market share, which could hamper its growth as these applications grow in the mix in the market. Number 2, Cisco has been losing market share across networking and security over the last decade, and will need to redouble its efforts against the likes of Arista Networks or cybersecurity platform providers. Number 3, Cisco's core markets of networking don't offer robust growth opportunities, and it has to seek top-line upside from nascent corners or other markets where it's less competitively advantaged. There you have it for a balanced perspective of some of Cisco's qualitative factors. Now it's time to give our rating. In analyzing Cisco Systems, stock ticker CSCO, this networking software and technology company is a perfect Select 6 stock. They earn high returns on capital, they've grown, they bought back shares, they have a cash position on their balance sheet while they generate a lot of free cash flow. Plus, they've supported a growing dividend, and their free cash flow to enterprise value yield looks attractive to the yield of the 10-year treasury. However, this is not financial advice. When we performed our discounted cash flow analysis, from today's valuation multiples, if these are the same 20 years into the future, an estimate of Cisco's fair value per share is only around $39. That's down $14 from their current stock price. The company last traded at those levels in October of 2022, so they were there not too long ago. Even if Cisco can't hit a full 15% rate of return, it looks like between its free cash flow and those free cash flow growth assumptions that it could generate close to 10% returns for shareholders. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. Looking at all the factors of our analysis, Cisco looks like an excellent candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Cisco, and let me know what business to look at next in the comments below. Thanks for learning about Cisco with me, and have a great day.